Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for June 17th, 2018. And incidentally, Happy Father's Day. This week's Pirls Stock Market Commentary video may have a slightly different appearance due to some WordPress technical conditions, which will soon be worked out. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.38 fell from 1.51 last week, continuing within bullish territory. The total count of securities in bullish or bearish patterns increased fractionally to 2,941. The count of bearish stocks increased 6%, while the count of stocks in bullish patterns decreased 3%. The Pirls PNF market breadth summary chart shows us a market now 6 weeks in bullish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 53 points for the 8th advance in 10 weeks, at a positive 549.39 points. It continues above the April and December 2016, January 2018, February 2017, May 2016, July 2017, and March 2018 tops, and continues below the remaining two tops above plus 100 in the last 30 months, as well as continuing above all 5 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 4 accumulation days and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum. The CCI 20 daily at a positive 101.03 is down from a positive 122.65 last week, without falling below our plus or minus 50 threshold. We continue to wait for the CCI 20 daily to return to the plus or minus 50 range for another zero-line reject long entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 111 weeks ago, while the daily CCI 20 began a Woody's uptrend 8 weeks ago. The CCI 20 weekly rose to a positive 164.50 from a positive 149.39 last week, continuing outside the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: some tech and retail on top, oil and oil services and REITs on the bottom. Bullish S&P retail continues in the top 5. Disk drives has re-entered the top 5. Brokers has left the bottom 5. Oil and oil services have entered the bottom 5. Bearish REITs has left the top 5 and entered the bottom 5. Gold and silver has left the bottom 5. Focus this week from www.northmantrader.com. Market Mysteries. The following are some key points and a chart. For more excellent charts, please see the article itself at Northman Trader. Unemployment at 3.8%, earnings growth at 26%, Q2 GDP growth pegged at a solid 4% or so, index and small caps making new all-time highs week after week, markets ignoring all potential bad news, that is, potential trade wars, political drama, etc., and volatility again crushed, with no signs of fear or concern, with a record corporate buyback program to the tune of $650 billion, offering a consistent bid under the market. In short, everything looks rosy. So why is the broader market not taking notice? Why, in fact, is the broader market not only making new highs, but why is the vast majority of the stock universe not only lagging, but showing potentially larger bearish patterns? These are important questions for investors to consider, as a number of market mysteries are unfolding beneath the positive headlines. The NDX screaming to new highs, yet the broader NYSE is not only down on the year, but it negatively diverged during the last NDX rally. The NYSE not only is not anywhere near the January highs, but it's engaged in a potential larger bear flag pattern. After a multi-week rally and nearly 42% of NYSE components remain below their 200-day moving average. NDX, which just last week again printed new all-time human history highs. FAANG stocks such as Amazon, Netflix, etc., are marching on to new highs every day. Netflix is up over 100% on the year. Amazon up 46%. Stocks that keep expanding market caps to unseen levels and appear bulletproof. Yet here too, in the almighty NDX, we can observe a massive bifurcation. Note, with each rally, the number of NDX components reaching above their 200-day moving average is getting weaker and weaker, an internal deterioration that has led to market accidents in the past. The main message? Index gains are driven by fewer and fewer stocks. If things are so great, then why are thousands of stocks not participating in this rally? As I've outlined previously, the narrowing of value expansion in favor of the few has become ever more pronounced in this latest rally. The data exemplifies the divergencies, and because of the market cap concentration, indices are masking the underlying weakness in the broader market. During the past couple of years in particular, we've seen a massive shift in investor behavior away from active investing to passive investing. The result? Investors who think they are diversified when buying an index fund may be a lot less diversified than they think they are. The implication? Complacency is back in full swing again, as volatility has been sucked out of markets, with VIX again showing readings in the 11-12 range. VIX at 11-12 with large swaths of stocks below their 200 MA. The bottom line here, select key sectors are making new highs on ever-weakening internal participation, while other sectors are showing distinct underperformance and bearish patterns, as volatility patterns suggest potentially bullish patterns. Central banks are pulling back in stimulus. The Fed will, albeit slowly, keep raising rates and reducing its balance sheet, and the ECB will end QE2 by the end of 2018. In short, in 2019, there will be a lot less artificial stimulus to go around, as the cost of financing is increasing and earnings growth will be slowing down. We are seeing markets negotiating the positive impacts of an artificially induced sugar high, with money allocated into ever fewer participants on the one hand, and weakening participation on the other hand, perhaps beginning to price in a new reality. 2018 is shaping up to be a peak growth year at the end of an extended cycle that was brought about by central bank intervention, artificial low rates, and global record debt expansion, all of which will be headwinds in a rising rate and deficit expanding environment with less stimulus to be had. All of which can be summarized in a single macro chart. Given historic midterm seasonality and current subdued volatility above its long-term trend, the current claim in markets may be subject to some testing this summer and fall. If the test turns out mild, new broader market highs may still come, yet a break below February highs may severely challenge the long-term trend of this bull run, and these current market mysteries will have presaged trouble to come. Thank you for watching this week's Santu Pirls Stock Market Commentary video, featuring the proprietary bull, bear, point, and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you're looking forward to a prosperous and productive week coming up, and wishing you true success.